All right, then this is my time to introduce and welcome everybody to this iteration of the Microstructure Exchange. Very happy to have Thomas Ernst here, who has a paper with Chester Spatt, and they're talking about what is the current perspective of this, the source of all evil, payment for order flow, and asset choice. So Thomas, the floor is yours. We're going to do the usual. Thomas has informed me that he's willing to take questions as we go along. If there are no questions as we go along, he will still pause twice so we can clear our minds. All right, everybody, go ahead, Thomas, pause yours.
Okay. Thank you very much. And thank you very much. I'm very excited to have, again, the opportunity to engage virtually with everyone in the microstructure community. So payment for order flow is an old topic. Chester was telling me it goes back to the 90s with Bernie Madoff. Continuing with Andreas' suggestion of payment for order flow being evil, Bernie Madoff is the one who really pioneered payment for order flow. Now it's gotten a lot of attention, as you can see in this, Google search trends really spiked with COVID. A lot of attention on payment for order flow. Part of what's going on here is the rise of zero commission brokers, where brokers charge you $0 to trade a stock. And it's the way they're able to make money is just by being paid to route your order to a specific market maker. Now, with this attention from retail investors, a surge in retail investors, this has brought a lot of attention from regulators. So what I have here are two quotes from Gary Gensler from last summer. So the first quote, he says, under the segmentation of the current market, nearly half of trading, along with a significant portion of retail market orders, happens away from the lit markets. I believe this may affect the width of the bid-ask spread. So there's a lot of concern here about this off-exchange internalization, that maybe it's bad that all these trades are being executed off-exchange. And if you look at this quote, it's really implicitly about the equity markets, because that's where off-exchange trading happens, right? There's no off-exchange trading in options. Everything happens on exchange. So this concern here coming from the SEC is just about equities. And then the other thing the SEC says is, brokers profit when investors trade. For those brokers who have these arrangements, not all do, higher trading volume generates more payment for order flow. So we know brokers are legally supposed to have clients' best interests at heart. Of course, they want to make money for themselves. So there's an inherent conflict of interest here with payment for order flow, which is your broker wants you to trade more. Okay, now again, in the context of this document, we think this complaint from the SEC is mostly about equities. And the concern might be, maybe brokers are going to have you trade too much equity. Okay, so when we go now to the real motivation for the paper is this graph here. This is aggregate payment for order flow across the top 5 brokers in the industry, which covers most of the industry and most of the payment for order flow. And what you see here is equity. If you look at S&P 500 stocks, that's a very narrow sliver at the top of this graph. Even across all stocks, that's not where most money in payment for order flow is. By far, most of the payment for order flow money is in options. It's way, way larger. Over 2/3 of all payment for order flow is coming from options and not stocks. So this is the graph. Chester and I saw, we were looking at the Robinhood, our quarterly earnings report. You see a very similar graph to this, where most of Robinhood's money comes from options. This graph is what made us decide, okay, we should write a paper. So what we're going to look at in this paper is, why does this picture exist? Why is there so much more money in options payment for order flow compared to stocks? What does that say about the microstructure of the markets? What does it say about execution quality? What does it say about the prices investors get? And then what does that do to broker incentives? Okay, so in this paper, we're going to go over 3 things. So first, we're going to look at execution quality in equities, and we're going to say that actually in equities, execution quality is pretty good, right? So first, brokers route to market makers paying for orders, and that's a broker benefit, of course. But second, market makers actually offer better prices. When they internalize trades off exchange, they give a small amount of price improvement, and that's actually a client benefit, right? So this is a win-win. Both the broker gets money, and that's a benefit ultimately to the client because they don't have to charge the client. But they also, this internalization process gives clients better prices. And what we show you is that actually internalization is most frequent when we have a 1 penny bid-ask spread. So if the concern is maybe all this internalization is making spreads wider, actually most internalization happens when spreads could not get any narrower, okay? So overall, we think the picture in equities is a pretty good picture. It's not as evil as you might have thought. On the other hand, we think in options, execution quality could be much better. So first, payment for order flow in options is much, much bigger. Partly that comes, payment for order flow has to come out of the bid-ask spread. Bid-ask spread is really wide in options, so there's a lot of room to generate profits and pay some of that profit back to the broker. But what we'll also show you is that while price improvement is very, very common in option markets, it's potentially of lower quality. We think that clients are actually losing out through this routing. We think they would get better prices if they weren't just routed to the market maker offering the most payment for order flow. And the way we're going to actually be able to show this is that we're going to have novel identification through designated market maker assignments. So what we're going to do is we're going to look at these DMM assignments on the exchange, and we're going to show you that if the designated market maker pays payment for order flow, execution quality at that exchange in that asset is going to be worse. Okay. And then the final thing that we're going to talk about in this paper is that this fact that options pay so much payment for order flow than equities gives rise to a new conflict of interest for brokers, right? It's not just that brokers want you to trade more, but in particular, they want you to trade options more. And we think that's a really bad conflict of interest. Because if you think about, trading a little bit too much equity is not going to hurt your returns very much. You're going to get cap M plus some noise. If you think about a retail trader going out and trading options, that's really going to change the returns on their portfolio. Okay. So that's a lot. That's a lot in one slide, but that's, the very high level overview of the paper. So I think maybe I should pause here for the first question break.
Oh, that was a very quick introduction. Are there any questions at this point? Probably a lot of things that you would be clarifying. Yep, go ahead.
Can I ask a question to Thomas? Just a clarifying question at the last one, conflict of interest. Is it clear that steering towards options make it more profitable? I understand the revenue or profit is larger in total, but it seems like the claim is that it's per unit also more profitable.
Yes, for the broker, right? We're not going to talk about the market maker here, the wholesaler. We'll maybe talk about that later. But now we're just thinking about the broker, right? All the broker has to do is route. And I'm assuming that the cost to route an option order is the same as the route an equity order, right? They just send it to the market maker. And so it's really different here is the broker profit. The broker makes a lot more money routing an option order than an equity order. Okay. Yeah.
Pete, do you have a question?
Yeah, I have more of an observation. You were pointing at, you were just talking about broker kind of obligations concerning the best interests of the customers. I think my understanding is that when a broker is executing an order, they have kind of a fiduciary duty in some sense to obtain best execution. But if a broker is steering a client towards a particular type of investment, it's more of a suitability requirement, which doesn't necessarily imply in the best interest of the client.
Yes.
So I didn't quite think that you got that distinction the way I just said it in your earlier comment.
Yes, that's a really good underlying point. But maybe what we would say then is it's very problematic that this microstructure is what it is, because it creates this big incentive alignment for the broker. And so maybe within options, the fact that we think they're kind of violating best execution and getting this payment for order flow, that gives rise to this other conflict of interest. And we think probably the way to fix the market is to fix the microstructure. It would be very hard to change, to see, our brokers recommending assets that are the best. I mean, it'd be very hard to determine which assets are they recommending, what should they be recommending. So we think the best way to fix this problem is to fix the microstructure and make sure that there's not this really big difference in what brokers make. Yeah, that's a really good point. Okay. So,
all right, any more questions? Okay, then go ahead.
Okay, so let me take a second, talk about the earlier literature. A lot of different work and a lot of different topics. One thing we're going to do here, we're just going to measure the total value of improvement that internalization is giving to customers. And we'll see that the numbers are pretty sizable. In the equities, it's not nothing. And in options, the amount of price improvement that's given is actually really big. Retail investors get a lot of improvement compared to the best bid or ask. But the other thing we're going to do is measure the quality of the improvement. And we'll show you that in the options market, we think the quality is lacking and that retail traders could get even more improvement if they weren't being routed according to payment for order flow. And then our other big contribution is to point out that there's this microstructure discrepancy between options and stocks that gives rise to this broker conflict of interest to change what assets they're recommending. And it's really hard to regulate what assets they regulate. We think, we have to fix the microstructure so that brokers don't have this big conflict of interest. Okay. So what I'm going to start with in my talk, I'm going to start with equity, then I'll go to the options, and then I'll talk about broker incentives. So in the equity market, we're going to show that this sub-penny improvement, it adds up, right? To the tune of hundreds of millions of dollars a year. We're going to show that this improvement is actually a big chunk of the bid-ask spread, and that this improvement is, actually quite robust. It's not sensitive to any sort of low latency strategies. So first, just as an overall picture of the market, what is price improvement? Well, let's start on the left. You have a customer. Customer is going to send an order to their broker. So that's the blue part. Now, the blue part is going to be a broker. Firms like Robinhood, Charles Schwab, Vanguard. Those are the brokers. They have a choice over where to route the order. They could send the order to the exchange, in which case they have to pay a take fee, or they could route the order to a wholesaler. And wholesalers will often give payment for order flow. So typical payment for order flow might be something like 20 cents per 100 shares that the wholesaler would pay to the broker. So a wholesaler would be a firm like Citadel. Now, Citadel has a choice. They could internalize the order, or they could route it to an exchange. If they internalize the order, to make sure they don't get in trouble with the SEC, they'll usually offer a small amount of price improvement, right? Fraction of a penny, better than the best bid or ask, okay? Now, they can also route the order back to the exchange. So Chester has a nice paper that he presented last spring, where he shows that for limit orders, if you have a limit order as a broker, if you think about routing to the exchange, you would get the market making rebate. But actually, you wouldn't want to do that as a broker. What you're going to want to do is send it to a wholesaler and have the wholesaler send that limit order to the exchange to get the market making rebate, because there's volume tiers. So it's actually, there's a really good reason that Robinhood's going to want to route everything to wholesalers and not to the exchange, even if they could get like a market making rebate. It's because the wholesaler can get those volume tiers. And so generally what wholesalers are going to do is they're going to send limit orders off to the exchange and just collect the make fee, but they're going to avoid paying take fees by internalizing orders. Okay, any questions about this? Okay. So what I'll go on to say then is we're going to look at all trades in US listed equities priced above $1. We're going to look from January 1, 2019 to October 31st, 2021. What we're going to do is we're going to use the same identification as Bainbridge, Jones, Song, and Zong. We're going to look for retail trades by looking for trades that receive sub-penny price improvement. These are the trades that get internalized. Now, there's a big problem with this measure, which is that we're only going to see the trades that get selected for price improvement. We're not going to see the trades that don't get selected for price improvement. So, so the paper we saw last week. So we were seeing last week, in that paper, there's a big problem if you use this just to measure retail activity, because it's not retail activity, it's retail activity that gets internalized. That's not a problem for our paper because we're just interested in the part that gets internalized. We're only interested in retail trades that actually do get internalized. So we're going to be able to identify those trades by looking at trades with sub-penny and price improvement. And what I'll point out here is payment for order flow goes to the broker, but price improvement goes to the customer. So that sub-penny price improvement is going to go to the customer. And so before I look at that price improvement, let's consider a basic fundamental. I probably could skip this slide in the microstructure exchange, but why are retail trades so attractive? Well, we might think that these retail traders are actually less informed, right? If they're less informed, they're going to have less risk. They're not going to buy right before prices go up. They're not going to sell right before prices go down. So what we're going to do is we're going to look at realized spreads. We're going to compare the trade price with the mid quote 5 minutes later on a realized spread. Positive means the market maker makes money. Negative means the customer made money. So as an example, if you buy at 10.05, the mid quote 5 minutes later is $10, then the market maker made a 5-cent profit. So if we look at realized spreads across exchange trades, around half of the time, realized spreads are positive. Around half the time, realized spreads are negative, okay? If we go just to retail trades, overwhelmingly positive realized spreads, right? If you look, even at the 25th percentile across all realized spreads, you get positive numbers. So what are we saying here? We're not saying retail traders are necessarily incredibly stupid, But what we are saying is the decision to internalize is made well by market makers. When market makers decide to internalize a trade, it seems like they overwhelmingly pick good times to do it. They earn positive realized spreads on the trades that they choose to internalize. Okay. So market makers really want retail trades. And what are they going to do? They're going to give sub-penny price improvement and payment for order flow to get those trades. And what we're going to show you is that the sub-penny price improvement is not insignificant, right? So if you think about a trade, say for $10.25 and 15/100ths, that sub-penny portion is 15/100th of a cent. That's a small number, but across big volumes, this can add up. We find that there's about 20 to 30 million per month in sub-penny price improvement. If you measure that out of all retail trades that get internalized, retail traders are getting about half a basis point of price improvement from that little sub-penny portion. Okay, so this is the graph, and it's pretty stable across time. Month after month, they're getting this sub-penny price improvement. With COVID, there's a big spike. There's a big spike in volume. There's a big spike in trades, retail trading, and thus retail trades that get internalized. Now, going back to one of Gary Gensler's original concerns, right? Well, concern was this internalization may affect the width of bid-ask spread. If you're taking all the cream out of the market, all these trades that are really uncorrelated with future price movements, what might happen to the exchange, right? What's left on the exchange is non-retail trades, or the trades that wholesalers don't want to internalize. Maybe those are the trades with really high adverse selection, and that might make quotes wider, right? Very big concern. But if you go back to this graph of sub-penny price improvement, what we've done is we've looked at sub-penny price improvement and said how much improvement happens when the bid-ask spread is 1 tick. That's that green line here. How much improvement happens when the bid-ask spread is 2 ticks? That's the blue line. And how much happens, at any possible quote? That's the red line. And what you see is that over half of all price improvement is happening when bid-ask spreads are at that 1 penny bid-ask spread, right? Spreads could not be any narrower in that case. If we were to ban payment for order flow, start routing all those orders to exchange, spreads would still be at the 1 penny bid-ask spread. So in terms of policy, one point we want to make here is if we were to ban payment for order flow and ban this sort of internalization, that would be a big loss for customers around half of the time, right? Around half of the time, these bid-ask spreads couldn't get any narrower. So if you want to change payment for order flow, you might want to think about changing tick size as well. So that's one of the first thoughts we have here, is that the current system actually does have some big advantages. When you're tick constrained, this sub-penny price improvement that retail investors are getting is actually quite a big benefit to them. Okay. So then if we think about how does sub-penny price improvement impact market maker profits, what we're going to do is we're going to take sub-penny price improvement on all trades, and we're going to take those realized spreads on all those trades, and we're just going to calculate an expense ratio. For every stock, we're going to say, okay, how much are market makers spending on just this sub-penny price improvement as a function of their profits? What we find is there's actually a lot of variation across stocks. So stocks that generally have a wide spread are going to have a lot of sub-penny price improvement, or sorry, subs that have a wide bid-ask spread, they're not getting very much price improvement. But here, some stocks are going to have 20 to 30% of market maker profits are going to be going towards sub-penny price improvement. That's actually a pretty big deal in those stocks, right? When stocks are tick constrained, market makers are actually spending a lot of money on giving this sub-penny price improvement to retail investors. This is, kind of a buy stock graph. If you actually look at, volumes again, most volume is going to be trades in those stocks that are tick constrained. And here, let me pause and highlight Hendrick's point, right, which is commissions are endogenous. That's a very good point here. When we think about banning payment for order flow, if we were to ban payment for order flow, not only would investors lose that sub-penny price improvement, the brokers would lose their source of funding and they'd have to find a new source of funding. So there's kind of a double loss here if we were to ban payment for order flow and not change the tick size. Okay. So, in terms of takeaways here, sub-penny price improvement is pretty big, right? $30 million a month. Now that seems like a small number, but if you think about half of that improvement happening in spreads that have a 1 penny bid-ask spread, that's actually a pretty big chunk of transaction costs that's being given to clients as a benefit. And so most of the subpenny price improvement actually happens when bid-ask spreads are narrow. Market makers actually end up spending a lot of their profits in that case on subpenny price improvement. And before we move on to options, there's one last thing I want to highlight from equities, which is, are these results sensitive to timing? Did investors really get the best price, right? Or maybe are investors, are they being overcharged in some sense with timing? So this is something firms have occasionally gotten in trouble for. So just, what would they actually do? Here's kind of a graph of the different timestamps we have available. So when you route to a FINRA member like Robinhood, they're going to have a participant timestamp on that trade. If Citadel internalizes your trade, they'll timestamp it with a participant timestamp. They'll be looking at a proprietary feed of trades and quotes in the New York Stock Exchange and trades and quotes at NASDAQ. There's also going to be a SIP timestamp. That's going to be the feed broadcast by the Securities Information Processor. Now, the problem that can come up here is if you compare the SIP versus the proprietary feeds, the SIP can be stale. So there are some cases where companies have gotten in trouble where they've seen what was happening on the proprietary feeds. They've internalized a trade relative to the proprietary feed when they knew that the SIP quote was stale. So one last thing we want to check is, do our results really seem like they're dependent on some sort of timing issues? So what we're going to do is, we're going to compare different methods of matching trades and quotes. All trades and quotes are timestamped twice. First, by their participant, and then second, when they actually get to the SIP. So what we're going to do is we're going to compare that participant timestamp with the SIP timestamp. We're going to compare, across trades, across quotes, and we're going to also look a little bit before and a little bit after. So what we find here is, in this graph, we're looking at the timestamp comparison, and we're asking what percentage of the time do you get different results if you change how you match trades and quotes. If you think about the SIP versus participant timestamp graph, that's right here. So that's right here. Let me draw a circle. If you look at exchange trades, around 40% of the time, there's a difference between the SIP and the prop feed, right? In other words, the SIP is stale about 40% of the time for exchange trades. If you look at retail trades, it's less than 10% of the time. Less than 10% of the time, is there any difference at all between the participant timestamp or the prop feeds and the SIP? So one point I'll make here is retail trades are actually not that sensitive to these sorts of timing issues. And it's because if you think about high frequency trading activity, it happens in very short bursts. There's these very short bursts where there's a whole bunch of activity, prices are changing, and you're sensitive to, getting stale prices. Retail traders very rarely get stale prices because they're trading at kind of random time. Their trades are not going to hit those brief burst periods where there are stale prices. Okay. So with that, let me stop. That's all I'm going to say about equity markets, which is, there's a lot of subpenny price improvement. We think it's pretty high quality, and that for a lot of stocks, it's happening when we're at that minimum bid-ask spread, and it seems not so sensitive to timing. So our conclusion about the equity markets is that execution quality is pretty good. What we're going to go now is we're going to shift to option markets. I'm going to show you that we think the execution quality is actually less good in option markets. So I'll take, Bjorn.
Yeah, very interesting findings, Tom. Just a question about that a high proportion of the PFOF is going to trades in tick constrained stock. Is that due to that there are many such trades, or is it more likely that those trades are paid payment for order flow?
It's that there are many such trades, right? So if you think about what are most people trading, they're trading Google, they're trading Apple, stocks that are at the minimum bid-ask spread. If you think about what market makers would actually what flow do they really want? Probably it's not just the Apple flow, right? What's, on a per trade basis, the most valuable stuff would be stocks that have a wide bid-ask spread, because if they can internalize that trade, that's a lot more profit for the market maker. Yeah.
Thanks.
Tom, I have a quick question.
Mm-hmm.
So basically the fraction of trades that are not receiving price improvements and hence not picked up by the algorithm, they're receiving a price improvement of 0. So I guess to the extent that that systematically varies across stocks, or whether or not the stock is tick constrained and stuff like that, that might change some of your conclusions?
So our understanding based on Bamer, Jones, Zhang Zhang and Bashar's paper from last week, our understanding is that when orders are internalized, they're always going to give at least some sub-penny price improvement, to make sure that they don't get in trouble with SEC. Citadel doesn't want to get in trouble. So whenever they internalize a trade, they're going to give at least a fraction of a penny. So you're right that some retail trades are not going to be internalized. So in terms of overall, what's the execution quality that retail traders are getting, you would have to think about that. If we're just focused, so in this paper, we don't worry about that because we're just focused on what's the execution quality they get when they get internalized.
Got it.
Okay. Marcus, yeah.
Hi, I have a clarification question. In the way you talk about this issue, when you talk about banning payment for order flow, are you assuming that we're not routing off exchange, or are you assuming that off exchange routing is still permissible?
Yeah,
the broker can't get paid for that.
So there's multiple possibilities. So one I suggested is, let's say, going back to Gary Gensler's quote, is it's problematic that all this order flow is happening away from the lit markets. One possible ban on payment for order flow might be we ban payment for order flow and we ban internalization, or maybe we just ban internalization. We think that might be bad, right? That specific variation would be bad, which is that you'd be losing the sub-penny price improvement. But yes, there's a lot of different ways we could think about reforming payment for order flow. So part of our paper is to dig in and say, okay, if we do want to reform payment for order flow, a lot of these tick constrained stocks, right? Investors would be worse off in these tick constrained stocks if they don't get that price improvement.
So the reason I'm asking is there are some brokers, sorry, the reason I'm asking is there are some brokers that route off exchange, but that do not collect payment for order flow. And then there are others like Robinhood that do collect it. So it seems like that's sort of a business decision on the part of the broker, which banning it might not, they would have to charge.
Yes.
Like the clients have to pay somehow, right? I mean, you're not running charities.
So a smart case in that case might be, okay, we can ban all the payment for order flow. Maybe it just has to go ultimately to the client, because there has been some work. We don't do this in our paper, but there's been some suggestion that there's a kind of trade-off between how much price improvement the wholesaler will give versus how much payment for order flow goes to the broker. Definitely, that split could be changed. Yeah. So I guess this is pro internalization, not necessarily pro payment for order flow, would be the evidence here. Shihao.
Hi, Thomas. Just a question. So I'm just wondering how actually frequent do we have a hidden mid-quote order on the lead market? So in that case, even if you have like the binding bid-ask spread of 1 cent, if there is a mid-quote hidden orders, and if the market maker can actually route the orders to the leads, maybe the it's better for the retail, right, than just giving a sub.
That's also possible.
Yeah.
Another broader question, I think, would be, what about off-exchange hidden mid quotes? And that would raise a whole question of, how should a market order be handled if we were to ban internalization, right? Like, could there be a lot of mid quote trading? Definitely possible. But we would say that's a feature that we would definitely, we're not sure that would be guaranteed. And the reason I think that's, not necessarily a guarantee is retail trades are really, really, it's great to trade against a retail trader. I think the reason they get so much price improvement here is not just that there's, interest to trade at the mid quote, but that market makers know that there's less adverse selection trading against these retail trades. I think that's what's going on here. Okay. So there's no other hands up.
Can I ask a question too?
Yeah, sure. Andres, go ahead.
I'm wondering, just on a broader scale, isn't a large extent of price improvement that we see for so many securities, is that not a very clear signal that the minimum tick size is a huge impediment to proper competition?
Yes, that's what I think. Yes, which is, if we want to reform payment for order flow, I think we should also reform tick size. Yeah.
Is there any sense that you have in terms of the order size that is being improved upon? Is it, odd lots versus non-odd lots?
I should look at that. We haven't. So we should do the odd lot versus non, and then also maybe look at, are these, do big round lots also get retail improvement? That's a good suggestion. But let me, to make sure I run out of time, let me actually take that. Oh, yeah.
I had one question. Sorry.
Yeah.
Have you looked at any of the quote flags to see if a retail liquidity program liquidity is present when some of the internalizations occur? Because exchange retail liquidity programs can execute in 0.1 cent sub-penny increments too.
Okay, right.
So kind of as a competitive mechanism against internalization too. So the quotes are hidden, but there is a flag disseminated, I think, in the SIP when those quotes are present on an exchange.
Got it. I should look at that. I might follow up with you on email, over email for more details, John.
Sure.
Yeah, thank you. Okay,
Thanks.
So let me take the point Andres was going, which is part of the problem here is, competition is limited by the bid-ask spread. So if the bid-ask spread is very narrow, then any sub-penny price improvement is pretty good. When the bid-ask spread is wide, there's a big problem with how much competition there is. So what I'm going to go to is in the options market, bid-ask spreads are wide, and we think there's actually a big problem in the options market. So first, in the options market, there's no off-exchange internalization. All the internalization, all trading has to happen on an exchange due to clearing requirements. You can't trade off exchange privately. You have to trade on the exchange because that's the only way your option trade can get cleared. And what we're going to look at is, given that you have to trade it on exchange, how could a wholesaler actually go ahead and internalize an order? What we're going to show you, one way that you can really internalize an order is to go to an exchange where you are the designated market maker, right? When you're the designated market maker in an exchange, exchanges want to attract volume. So what they'll do is they'll adopt rules that are very beneficial to the designated market maker, okay? One of the rules they've adopted are a series of rules around what are called price improvement mechanisms. And these mechanisms are all about facilitating internalization. So suppose firm A, they're a wholesaler and they want to internalize an order. They can't do it on their own books like they can in equities. They have to go through an exchange. What they can go through is what's called a price improvement mechanism. Okay, it goes by different names. PIM, that's the acronym we use. It's called CUBE by one of the exchanges. AIM, Automated Improvement Mechanism. Single leg, non-ISO, auction. There's a bunch of different terms. They all refer to the same structure. What it is, it's an auction mechanism. Firm A will propose a bid, and then there's going to be 100 milliseconds where anyone can come in with a competing bid. So, Firm A could say, okay, we have a customer trade. We want to execute it at $4.75. That's 25 cents worth of improvement compared to the best ask. There'd be a 100 millisecond interval where anyone else could come in with an even better bid. Now, in this auction, designated market makers actually have some really big advantages. So they're going to have lower trading fees outright, that limits anyone else from competing with them. They're also going to have a larger pro rata allocation. So if there's multiple bids, options exchanges usually use pro rata allocation. Everybody gets some piece of the action. The designated market maker will usually get a piece that's twice as large as anyone else's, and sometimes even bigger, depending on the order size. And then finally, what we think is probably the most important one is the designated market maker can automatically match any incoming bids. So if you think about that, that creates, a very big winner's curse problem, right? The only time you're going to win in one of these price improvement mechanism trades when you bid is if the designated market maker does not want to match your bid. So there's a very big adverse selection problem in terms of competition here, right? Really big winner's curse problem in these auctions. So just to go through the process, how would you internalize a trade? Well, let's say wholesaler A wants to internalize a trade, even if they don't have a best quote out there. So let's say the best ask is 1150 and designated market maker is quoting, firm A is quoting 1155. What they can do is they can go to exchange where they are the designated market maker and say, you know what, we're going to propose a price improvement auction starting at 1149. Okay. Now there's 100 milliseconds for anyone to match, but we think the competition here is pretty weak because if anyone tries to match, the designated market maker can automatically match their bid, right? So no one else gets to see what the bids are. You just bid blind, but the designated market maker can automatically match any incoming bids. Right? They're also going to get a larger allocation of the trade. So there's a big incentive here to internalize where you're the designated market maker. So what we're going to look at is, do these designated market makers, in these price improvement mechanisms, first, we're going to look at how much price improvement is given. But second, we're going to look at whether payment for order flow seems to impact the amount of price improvement given. Okay, so part one, we're just going to look at how much price improvement is given. And what we see is that the price improvement given is huge, right? So in equity markets, we were looking at 20, 30 million a month. Here, we're looking at $100 million a month in terms of price improvement that's given to these trades. Okay, so the numbers are a lot bigger here. There's a lot of savings to retail investors. But the other thing you'll notice here is that these trades are not at all tick constrained. If you look, before we were showing, okay, a lot of the price improvement at one tick, half of trades were getting price improvement when we were at the minimum tick. Most option trades are not tick constrained. There's no tick constraint, very rarely are options markets tick constrained. So when you look at the price improvement, most of the price improvement is actually happening when the bid-ask spread is wider than 2 ticks, okay? So there's a lot of improvement happening. So now what we're gonna look at in this paper, here's a histogram of price improvement, big numbers, right? 5, 10 cents per trade. What we're gonna look at is, does the fact that there's payment for order flow present in this market seem to impact the quality of price improvement that investors are getting? Okay. So what we're going to do is we're going to exploit the variation in those designated market makers. We're going to compare the outcomes and price improvement auctions where the designated market maker in that stock pays payment for order flow versus where they don't. The underlying assumption here is that on average, where are you going to take an order? If you want to internalize it, you'll take it to where you are the designated market maker. So if we look at places where there's payment for order flow designated market maker, that's where these trades most of the trades there are going to be actually brought by the designated market maker. So just to let me give a concrete example, and then I'll stop for questions about the strategy here. So here we have SIBO, right? Chicago Board Options Exchange. Every single stock is going to have a designated market maker. So in Coca-Cola, all the options, the designated market maker is GTS. Walgreens, the designated market maker is Citadel. So what we're going to do is we're going to look at SIBO and we're going to say, okay, do the price improvement mechanisms in Walgreens seem to deliver better or worse prices than the trades in Coca-Cola? Citadel pays payment for order flow, GTS does not, right? So that's one level of comparison we're going to do. Another comparison we're going to do is we're going to look across exchanges. So over at Miami, those actual assignments are flipped. Citadel is the DMM in Coca-Cola. GTS is the designated market maker in Walgreens. So across exchanges, we're going to say, okay, do Coca-Cola price improvement trades get better prices at SIBO versus Miami? Okay. And what we're going to really do is there's going to be a long list for each exchange of all the designated specialists. So we're going to fit a stock fixed effect, and we're going to fit an exchange fixed effect. What we're really curious about is across all the different stocks, do price improvement mechanisms get better price improvement when when the designated market maker pays payment for order flow versus when they don't? Okay. So let me pause for a second. Any questions about the setup here?
Hi, Tom, this is Amber.
Yeah.
Yeah, so I'm a little confused about some things. So first is, I think a lot of the internalization happens not through the price improvement mechanism, but basically just from the priority rules. Like if DMMs can 1 to 5 contracts automatically, then that just goes through them. The price improvement mechanisms, in my understanding, are basically to avoid, it's order flashing so that you can avoid trade throughs and you don't have to route out to other exchanges. So that's the main goal of this. And third, is this right that on the same exchange, some DMMs pay for order flow and they don't? Because those exchanges will charge a payment for order flow fee per contract, right?
Right. So the exchanges will have, there's make-take pricing and payment for order flow pricing. When I talk about payment for order here, I'm just talking about the payment for order flow that's actually accruing to the broker. So when we look at SEC 605 recordings of who is actually paying Robinhood to get their orders, Citadel pays Robinhood to get order flow, GTS does not. And this is true across all brokers. GTS doesn't pay payment for order flow and options, Citadel does. Okay. So Citadel is going to be purchasing retail flow. They're going to have retail flow coming from the big brokers. We know GTS is not. Okay.
So where does GTS's flow come from?
It's going to come from non-retail clients. So one aspect here is we're comparing retail versus non-retail. We think that's an okay assumption to make, which is we're going to assume that retail traders should probably get more price improvement than non-retail, right? And what we're going to show you is that we're going to show you some evidence that they're actually getting less price improvement. Okay.
Okay.
Yeah.
Thanks.
John, go ahead.
Hi, I have a question, Tom. Can you go back 2 slides to the mechanism?
Yeah.
The one before. Yes, this one.
Yeah. Sure.
I wondered the one after. Sorry, I wonder whether how important is the DMM mechanism is going to affect the best ask that are posted on exchange 2 and 3 for the same kind of winner's curse mechanism you have in mind. So the idea is if I know that DMM will be very competitive in exchange 1, as a market maker in exchange 2 and 3, I'm also wide on my bid-ask spread, and hence it affects sort of how many orders are going to be binding at the tick size, and then how much room for improvement you can offer in the end.
So yes, we think, we don't directly show it in the paper. This is something maybe we're working on for the future, but we think part of the problem with options quotes, why are they so wide? It's because it's not super competitive, right? Why do you want to post in a wide spread if you know? So this is where I think Gary Gensler's statement that this may be affecting the width of the bid-ask spread. We think that's actually maybe pretty true in options, which is we know the retail trades are going to go to where the DMM is. It's going to try and get internalized. We know they're not going to hit the regular quotes. So that actually might really be impacting the width of those quotes. Definitely. We think that statement is actually quite valid for the options market. Yeah. Paul, you have your hand up.
Sure. Thank you. I just have a real simple question. In this options market, we've had so much volume lately. We have a secondary demand for trade because we have a big inventory risk. And normally I'd send this to exchange. The market maker would have to offset the delta with a trade. All I want to know, Thomas, is so how's it work now? Is there any major, is wholesaler A or exchange 1? Are there different people holding that inventory risk for any period of time?
Yeah. So can you maybe rephrase the question? Or I guess, what are you thinking is going to happen?
Well, I just want to know if, for example, wholesaler A gets the order, right? So they're just routing. They're not going to execute. Okay. So that's just simply, there's no inventory risk yet until it goes to one of these exchanges. And what happens if it goes to exchange 1? Who picks up the inventory risk and has to do the offsetting trade?
Oh, so we think that they route it, wholesaler A would route it to a place where they're a designated market maker because they really do want to pick up the risk. So wholesaler, right, that's going to be something like, it's not going to be Robinhood. Robinhood is the broker here. In this graph, Citadel, Wolverine, Susquehanna, those are going to be the wholesalers. We think they want to internalize these trades and take on the risk.
Oh, okay. Thank you for your time.
Okay. Yeah. So, I mean, maybe we follow up on email if there's something I'm not understanding about this, but we think, the whole reason that they are trying to internalize it, they're trying to take the other side of the trade, right? Now, maybe there's one other point here, which is part of the reason options are pro rata, is that there's an argument that maybe everyone wants to share the risk. You don't want one firm to take the whole trade. Maybe they do want to split it up, right? They each are going to take a piece of the trade. So it could be maybe Citadel takes 40% of the trade, a whole bunch of others take some small portion. Okay, so let me get to our main result, right? We're going to look at price improvement, and we're going to look, if the designated market maker pays payment for order flow to brokers versus if they don't, and we're just going to compare outcomes. We're going to look at the price improvement in those price improvement mechanism auction trades. We're going to control for days to maturity. We're going to control for all the Greeks. We're going to control for delta, beta, vega, all those things. We're going to control for the price of the option. We're also going to include a fixed effect for each stock in each exchange, right? What we're going to do is we're going to say, okay, if the designated market maker pays payment for order flow, are outcomes better or worse? And what we find is there are worse outcomes, right? So when designated market maker at an exchange pays payment for order flow, you get about 50 to 100 basis points less price improvement. So this is one estimate. I show you, we say, okay, it's 50 basis points less improvement. We do a rolling regression. We get anywhere from 150 to 50. When we do a bootstrap of just drawing random days, we get 100 basis points less improvement. So the idea here is if your designated market maker is a firm like Citadel or Susquehanna that pays payment for order flow, the outcomes we see in price improvement mechanism at the exchange are worse. We see less price improvement relative to when the designated market maker doesn't pay for order flow. Then going back to Aman's question, of course, there's going to be a clientele effect here, but where are retail traders going to be? They're going to be at those payment for order flow places. So what's shocking is that it looks like retail investors are actually getting a worse deal than non-retail investors. And if we had to guess, what should happen, retail traders should probably get a better deal because we think of them as having less adverse selection than a hedge fund. Okay. So then in the last, I'm over time here, but let me spend 2 minutes to say, okay, what other problems does this create? Well, this is, getting back to Pete's point. Well, what we're going to say is the microstructure problem here, where brokers have a best execution requirement, the fact that options pay so much more is going to give them an incentive to really encourage their clients to trade options. So first, this is just on a per share basis. If you look in the 605 reports, brokers like Robinhood are getting paid about 40 cents a share for option trades that they route. They're getting paid 10 to 20 cents per round lot for stock trades that they route. And if you think about the price, that's going to magnify these differences, right? So if you think about investing $1,000 in a $100 stock, that generates 2 cents for your broker. If you think about investing $1,000 in a $10 option, that generates 40 cents for your broker. So actually, if you think about it, options are usually very cheap, which means if retail investors are just going to make a nominal investment in options, they're actually going to generate a lot of shares and a huge amount of payment for order flow for their broker. And then really simple, if we just look at what options traders, retail option traders are doing, they're buying options that actually have very volatile returns. So what I've done here is I've compared, just a bunch of retail stock trades randomly drawn from the market versus the S&P 500. And what you see is investors in the stock market, they're pretty much getting the S&P 500 with what they're trading. Now, if you look at what they're actually doing, if we look at these PIM trades, which are overwhelmingly retail, if we look at the outcomes they're getting based on what they're trading for options, in some months, the retail traders actually do very well. In a lot of months, the options that they're buying are going to all expire out of the money, right? Looking at, if you think about drawing a random portfolio of retail option trades from the option trades that we see in the market, over half of those options are going to expire out of the money with a total loss for the investor, right? It expires worthless. So let me conclude, and thank you for letting me go a little bit over time, and then I'll stay around for questions, which is when we look at payment for order flow, we actually think execution quality in equities is pretty good, right? So there's two things that are going on here. One, brokers are getting a benefit. They're getting this payment that they presumably can pass on in the form of lower commissions, but also the investors themselves are getting this price improvement. That's a client benefit. And if we were to change the market, we'd want to preserve this feature. So if you do want to change the structure of payment for order flow here, this is something that would need to be preserved, maybe with changes in tick size, changes in letting retail traders place more mid-quote orders. So equities are pretty good. Options we think are actually quite bad. If we look at these price improvement mechanisms, there's a really wide bid-ask spread. Retail investors are getting a lot of price improvement. But when we look at designated market makers, there's a lot less price improvement that's given in auctions when the designated market maker pays payment for order flow. So what we think is going on there is brokers are routing the order just according to the payment for order flow payment. They're routing to designated market makers who give less price improvement in these auctions. And finally, that gives rise to a big conflict of interest for brokers, which is they get a lot more money from options. So if they really have a choice, the microstructure here gives them a big incentive misalignment where they want to encourage their clients to trade options. Okay. All right, so that's my last slide there. I'll thank you very much for the extra 4 minutes, and I'll stick around for questions.
Well, let's go by the order that we see. So Yashar, maybe you go first.
Yeah. Oh, Yashar, you're on mute.
Thank you, Tom. Sorry, very interesting paper. So I have a quick question about how you measure the price improvements. Are you relying on the sub-penny fraction of the execution price only?
Yes, we're just taking the sub-penny because our concern is if we actually try to measure against the quote, what we found is we think we're hitting stale quotes. Because if we look, say in March, what happens in March is the price improvement measured against the quotes, it just explodes. And we think that's that, there were a bunch of stale quotes at that time.
I think that's a totally important point, but I've done some investigation of how that sub-penny price improvement, like the sub-penny increment, might lead to potential misclassification of trades into buy versus sell. For example, suppose that bid ask is like 6 cents, and then you have a price improvement of 1.7 cents, then the algorithm tells you that the price improvement is only 0.3 cents, even though it's 1.7 cents, and it misclassifies it as sell if it's a buy or vice versa. So, I mean, from that perspective, you might be to some extent understating the benefits. Quality. Yeah. So.
Okay. Yeah. So in the appendix, we have a version where we go through and measure against the quotes. And maybe we should actually reference those numbers a little bit. And maybe just highlight that what we're doing is the conservative thing here, because we really don't know if those are stale quotes or bigger than price improvement. That's a good point. Thanks.
I agree. Yep.
Albert, you're next on my list.
Thanks for giving this paper. It's very, very interesting, particularly the PFOF for equity options. Now, when I read your title, I was hoping for a little bit more on the asset choice part. And of course, where undoubtedly you've been thinking about it, so I was just interested to hear your thoughts. You'd want to look for some time variation where these PFOF arrangements started to kick in and have a sort of before and after to see what, of course, is the most troubling part of this, that this has led to a different asset class because of these arrangements. That's a little bit the appetite you were raising with me when you introduced the topic, but there's not much results there.
So right now we're just pointing out the incentive misalignment exists. The challenge with going further and saying, okay, and it also really did change how investors invested. I think one of the biggest challenges there is, what do investors actually want to invest in? I think that's a really, really hard question to answer, because if you go to the broker and say, okay, we think you're encouraging too much, you're encouraging your clients to trade too many options, they'll say that's just what our clients really want to do. So we are collecting evidence on this. We're hoping to have some updates soon. Some of the things we've been looking at are just search history. We're hoping that we can just find from search history, how do firms seem to change how they market themselves. If we had the actual data from a broker, then we could say, okay, when broker I adopts this payment for order flow setup, they change how their clients, their asset mix of their clients changes. The problem is we only observe aggregate, and I don't think there's any big sharp changes in time differences in aggregate. I think there's only broker by broker.
Okay. You're hoping for some discontinuities. That's sort of
yes. If you think of a aggregate discontinuity, please let me know. But I think most of the discontinuities we can think of are basically firm specific, and we're not going to be able to pick that up in the aggregate data.
Understood. Thanks a lot.
Thanks. Pete.
Yeah, continuing on this question of brokers' obligations, how do front-running rules apply to the situation where a broker routes an order to a firm that pays for order flow? They route it to a captive market maker on an options exchange, and then the captive market maker tries to match, a price. It seems like they can't match a limit price on an order without front-running.
Yeah,
so I don't know what the legalities are. Maybe you have some.
I think based on what we're seeing, it looks like there's usually always at least 1 penny of price improvement. It's always hard to say whether we see some price improvement mechanism trades where there's no improvement. We think that's probably just stale quotes. So we think one of the rules with these price improvement mechanisms is you've got to include, at least 1 penny improvement over the lit markets, so that avoids the front running problem. So if the best ask is 11.50. Then you've got to start that price improvement mechanism auction at least 11.49. Does that make sense?
Yeah, you're saying that the rules apply on the other side of the market. If I'm a client buying,
yeah,
you're saying the market maker cannot front run my order by buying ahead of me, but he can front run in some sense the order coming from somebody else to sell to me.
Yeah. So yeah, the way they're able to front run those quotes is they offer a little bit of improvement. Yeah.
Right.
So if you started the price improvement mechanism at 1150, that'd be front running those other limit orders, but you can start at 1149.
Right. Okay.
Yeah.
Thanks.
Good question. Amanand.
Yeah, I don't think that's true. And I don't, like, as I said, most of the trades will go off at the codes. The price improvement mechanism will kick in most options markets only when the quoted price of the exchange is not the same as another exchange. So
Yes.
for example, DMMs will take all order flow up to 5 contracts automatically at the quote, right? Without offering any price improvement.
If they're already at the best quote, yes.
Right.
So if you have a best quote at a market where you're the designated market maker, then yes, you can just route there and internalize. So one of the things,
any order coming in up to 5 contracts,
yes,
the priority rules say they can take that, right, if they choose to. So
it's actually yes. So if they're at the best quote, yes.
Right. So there's no price improvement on those trades, right?
Right. Yes. So we're actually missing. That's the other thing, is we're only looking at when retail traders get price improvement. It looks like they get less than, so there's another big chunk there, which is there are a lot of retail trades that maybe are not getting price improvement and should get price improvement. That part we're also missing. Yeah.
And I think that's the bigger chunk. So I think this is probably a big underestimate. And the other thing is, in OPRA data, you can tell which ones go through the price improvement auctions, right? So
we can, but then with trades that don't go through price improvement auctions, we can't tell what's retail and what's not in the OPRA data.
Right.
That makes sense.
Well, right. No, but the point I was trying to make was that there's significant variation across exchanges in the amount that goes through the price improvement mechanism.
Yes,
and
definitely.
Like I remember the Boston used to be like 60% of all their flow went through that, right? So you probably see some exchange.
So that's why it's really important, we think, to have exchange fixed effects, because some exchanges really are set up to target PIM trades. Some exchanges really are not set up to target PIM. So it's really, really crucial to have that exchange fixed effect in there. Yeah.
Okay. Thanks.
Yeah, thank you. Josh, you're next on my list.
Hi, yeah, thanks for the talk. Just a quick clarification question about institutional details. So if I understood what you said, you were saying that in equities, whether or not payment for order flow happens is determined at the level of the retail broker. Like there are some brokers who demand payment for order flow and others who don't accept it. But then in options, it's the reverse. In options, it's decided at the level of the wholesaler. So there are some wholesalers that pay it and some wholesalers that don't. I just wanted to make sure I had that right.
Same, you could say the same is true in equities, in that there are some equity wholesalers that don't pay payment for order flow, right? Really, market maker, right? There are some market makers, some designated market makers in equities who don't pay payment for order flow, just like in options. What we think is really different about these two is when we look at designated market maker assignments in options markets, we don't do that same thing for equities because we think it's less important who the designated market maker is, because you can just trade off exchange. In options, you can't trade off exchange. You have to trade on an exchange. And that's where we think the designated market maker assignment becomes so important, right? The only time, if you want to internalize a trade, what do? You bring it to a place where you're a designated market maker. Does that make sense?
Yeah, maybe I'll have to think about it a little bit more. Thank you.
Okay.
Thanks.
Maybe one other thing I can say, right, which is if we're looking at Robinhood, right, Robinhood's going to get payments from firms like Citadel, Virtu, Susquehanna. In the equity markets, we can see directly which trades get internalized because they happen off exchange with sub-penny improvement. In the options markets, we kind of have to indirectly figure out which trades are retail trades getting internalized. And what we do in the options market is we compare, okay, if we look at the designated market makers who pay payment for order flow versus the designated market makers who don't, how do price improvement mechanism trades vary between those two? maybe the equivalent comparison in the equity market would be compare those internalized trades versus the prevailing bid-ask spread, where, because that's what the price at which exchange trades would take place. So we're doing a little bit of a different comparison here when we go from equities to options.
I should briefly interject that the official part is again at noon is now over. Thomas has agreed to hang out a little longer and answer some more questions. I just wanted to highlight this to everybody. Probably Björn will also stop recording soon. So anyway, just carry on, everybody.
Okay. So Cheng.
Yeah, hi Thomas. Maybe simplify the results. It seems like if the client paying no fee, if the service is free, then the clients are the product story, the product or broker to the wholesalers. Then I'm wondering if the wholesaler provides less price improvement, will they charge higher fees, or is it the reverse? Like because they have to pay the brokers a lot of payments for order flow, then they keep the balance by doing less price improvement.
So from the public data, really hard for us to determine because everything's at the aggregate level. In the equities, we don't see which individual wholesalers there are. What price improvement individual wholesalers are giving. We just see the aggregate. There was a settlement between the SEC and Robinhood, which if you look at the settlement, it goes through the argument that when Robinhood demanded more payment for order flow from the wholesalers said, okay, we can give you more payment for order flow, but we're going to have to give less price improvement to your clients. So that effect is definitely there. The only thing we can really identify from the public data is just to look at payment for order flow versus no payment for order flow among DMMs. Maybe we could try to look at sort of the individual. So the individual designated market makers will show up in the 605 reports. We haven't seen any big consistent differences there in terms of how much they're paying on a per share basis to each broker. So if you look at broker routing, they're going to get kind of the same payment from each firm that they route to. Where there are bigger differences are across brokers, where some brokers will get more per order than other brokers. And again, that's not something we can really follow up on in the public data. Yeah, Anna.
Hi, very interesting talk. I have two questions. So first of all is about non-marketable limit orders. Do clients, Robinhood clients, get any price improvement on those? That's question number one. And question number two is about OPRA data. So we looked at those trades less than five shares or less that go to the CMM. And 15% of them in the last 2 years of OPRA data are outside NBBO, which makes no sense. We asked market makers, and they told us that this is because of OPRA data, that some quotes are stale, and whether this is a concern and what you think about it. Thank you.
Yeah. So the first question, I would actually say, just go back and watch Yashar's talk. He does a much better job on thinking about whether non-marketable orders get internalized. Marketable limit orders, I think those can get internalized. Non-marketable limit orders, those are usually not going to get internalized. Those will just be routed to the exchange to collect the take fee, but they'll actually do it through the wholesaler because the wholesaler, because the wholesaler trades so much volume, they hit those top volume tiers on the exchange. And so volume tiers are really, really important across all these markets. So, but if you want to know more, I think Yashar's paper just does a better job on that question. So then to the second point with the OPRA data, shorter answer is we don't know because we're also using the OPRA data. Exactly how you match those trades and quotes, kind of a mystery. What we've heard from our data provider is they really have cautioned us not to think of this as a causal relationship. We do have the best bidder ask that's taken from the exchange. So we usually use that one instead of just whatever the OPRA quote is. We usually use the exchange's own quote. And we think that gives us a much better result. It's still not, there's still a lot of questions in there because if you think about, this auction lasts for 100 milliseconds, are we looking at the exchange's quote at the start of that 100 milliseconds or the end? Like big questions there. And the short answer is, I guess I would say I agree that the data is probably problematic. Yeah, so we're thinking the next stage is maybe to get the actual data from the exchange direct from the exchanges, not through Oprah, but of course that's a lot more expensive. Yeah. Pradeep.
First of all, really an outstanding talk, very interesting. My question is really in relation to the options market. So, and in that context, I would say that the spreads are very large, as you know, but most trades are trades in which you are trading two options at the same time. So you are rolling over trades. You are, you're doing spread trades, and so and in that is where the spreads, where the actual trading cost that the trader faces. For example, a retail investor is very tiny, and I mean, I would say that's one thing. And the second thing is trading within the codes. The spreads are very large, but I have found that virtually 100% of the time, if there's a limit order within the codes, it gets executed every 95% of the time. And I wouldn't think of just trading just on the spread. So how much of the real sort of trading activity was one capturing if one is focusing on just the...
So two things. Yes, we really are cutting down the public data down to get to what we can observe. So on your first point, we're actually only looking here at single leg trades. So we're not looking at, if people are trading a straddle, any sort of multi-leg trade, we're not looking at that. We're just comparing single leg trades at one DMM versus single leg trades with another DMM. So that's the first big cut of the sample. We're just looking at single leg trades.
What proportion of trades are single leg trades in the entire options market? I mean, I would think they would be pretty small.
We have not found that to be the case. I should double check the actual numbers, but I think we're actually capturing a pretty big chunk of the data. If you have ideas for how to work with multi-leg trades from the Oprah data, I'd be very curious to follow up with you. I
will certainly think. I will certainly think about it. I mean, from a practical perspective, my fear is that with your with the recommendations which kind of come out of your paper, if there are changes in the options market, most of the trades are multi-leg trades. At least that's what I would think. And in that context, that becomes very similar to what you see in equity markets, where there is price improvement on very small, tiny spreads. So, I mean, I will think about how one can sort of take a look at it. That's my observation.
So I would say then maybe the one recommendation in our paper is that we think these auctions should be made more competitive. It shouldn't be the case that the designated market maker has such a big advantage. And I would hope that that extends both, across single leg trades and also multi-leg trades.
You see, there's a reason why multi-leg trades have very low spreads, and that's because the market maker's risk is offset.
Right. Yes, definitely.
And therefore, the spreads which are offered are much smaller and much more practical.
Yeah. Yes. So we're just looking
excellent paper. Excellent paper. Thank you.
Okay. Thank you. Thank you, Pradeep. Anyone else? I don't see any other hands up.
Tom, sorry, just a quick thought. This might be totally wrong, but to the extent that in the options market, the designated market makers are willing to take the inventory risk, I'm wondering what is the role of their trading strategy in hedging that risk? For example, short selling or whatever to delta hedge, or stuff like that. So I think that to the extent that that is costly to the DMM, that might explain some of the fact that there is little execution quality.
So one thing we're going to say is, whether option, quotes they should be wider than equities, right? That's always going to be the case. That said, if you think about, if we just think about that as, specific to an asset, that options are always going to have wider quoted spreads than equities. What that means is if there's a client, like a retail trader, the cream, where that the spreads are too wide, the options offer a really crappy bound, right? Because the spreads are, they should be wide. They're wide, but they should be wide because options are just a riskier product. So part of the reason we think that the conflict of interest is, in the microstructure, it's always going to be worse in the options market, is that in the equity market, you're always given that really tight bid-ask spread, right? So you can't get any worse than the best bid or the best ask. So you can't do that badly. In the options market, we think that there's actually a lot more room for improvement, and that's why there's such a problem in the options market. People should get a lot of improvement, and they're only getting medium amount of improvement. Okay. Yeah. Thanks. Hank had to leave. Oh, sorry.
Yeah. So, all right. So I think we have to let Thomas leave because he has to teach. And I want to thank you again for the great presentation and a great discussion too. It seems to have a lot of interest here in the crowd.
Yes. Well, and thank you very much for all your work organizing the series. Really enjoyed.
All right. Very good. Okay. I'll see all of you in 2 weeks.